Okay, good evening, everybody. Welcome to our Facebook Live session, Ask Me Anything, brought to you by the Institute for Financial Literacy, collaboration between MoneySense and the Singapore Polytechnic Enterprises. This evening session is on personal investing, entitled What Should You Look Out For? So it's an opportunity to ask any questions that you have. We will set the groundwork in a short while with some context, but later on we'll look forward to your questions coming through Slido. Before we begin, first a little bit of background on the Institute for Financial Literacy. As I mentioned earlier, the Institute for Financial Literacy is a collaboration between MoneySense, the National Financial Education Program, under the umbrella of the Monetary Authority of Singapore, and the Singapore Polytechnic Enterprise. The Institute for Financial Literacy is the outreach arm for MoneySense, and we conduct public forums as well as talks, as well as sessions like this, right? So very nice of you to connect with us, and we hope we have interesting discussion this evening. Before we dive into the content, obviously we need to just set some context in terms of disclaimers. This session is a dialogue, is for information purpose. So should we mention any companies, and specifically we're talking about investing. So obviously we're going to talk about some companies, stocks, or even bonds or instruments that are listed and publicly available. So just understand that this is really to illustrate the points and the questions that we get and the answers that we're trying to help you address. So you should consult a licensed financial advisor before making a decision to invest in your product, or any product for that matter. Make sure that the licensed financial advisor understands your needs, your risk appetite, as well as what are your circumstances. Okay, so let's kick things off with the topic today, and just sort of lay some context and some framework as to some things that people typically may want to ask when they're starting on the investment journey, right? Some people are unsure how to get started, so that's the fundamental question. How do you get started? What do you need to consider? What do you need to be? How prepared should you be, etc. And then, of course, there's always a question: how much should you invest, right? Is there a minimum sum? Is investing a few $100s too small, or do you have to be very rich to invest? We can address that if the topics are also if the questions come up. What's the difference between products? So you typically bonds and shares, or unit trusts, investment-linked policies, ETFs, so many types of different different asset classes in the market. So we will give some context as well. And things like REITs, right? REITs also is another asset class. Is it considered fixed income? What is it? Is it a stock? Because it has a share price. I mean, the price goes up and down as well. So is it more of a stock-like? Does it behave more like a stock, or does it behave more like a fixed income instrument? Okay. So there's some context just to get your brain juices going, but obviously like to hear questions that are more particular to you, or something which is on your mind. Okay. So before we get things going, we're going to do a poll, right? We're going to launch a poll just to get some sense of how many people have actually started an investment journey, or maybe none at all. Okay. So my colleague will launch a poll. You should see it, and maybe just give us your input. Okay, I'll pause for the poll to come up. Okay, while we are getting the poll up, well, let's talk a little bit about investing journey, right? Maybe just a bit of a background. Investing, for me personally, I've started investing only about, say, 10 years ago actively. Earlier than that, a little bit more of a passive investor because of work circumstances. But investing is quite unique. So I've got a little, I'm like, if the opportunity comes, I'll share a little bit of my experience as well. But I think everyone has a little bit of different experience as well. So I'd like to hear from you as well as we do our discussion, right? Okay, the results of the poll are in. Actually, wow, 56% of people, of respondents have invested in shares, majority. Bonds 11%, unit trust 0. Okay, unit trust, sometimes you may have been investing in unit trust without knowing it, so we can talk about that maybe through insurance policies. And 33% have not invested at all, maybe considering to start. Okay, so it's good. So most people are very familiar with shares. Okay, so with that, let's start and let's go into the different individual securities, right? So shares, everybody, the majority of people have invested in shares. So a little bit about shares. So most people know that they're issued by companies, right? Primarily by companies that have a business, right, to raise capital. Usually, the shares gives you a little a percentage ownership of the company. Yeah, you have as a shareholder. The shares, we invest in shares because of two reasons. One is we believe in the future of the company. We want the share price to appreciate in value. And we also hope to, some people invest also for the dividends, right? Dividends are a coupon that pays at the end of each financial year. The company makes money, it will declare a dividend. The dividends are, of course, not guaranteed. Okay, dividends are not a fixed coupon, so it depends on whether the company makes money. And even if a company makes money, they may choose to declare lower dividends or higher dividends, really up to the board of the company, right? Is listed there as a hedge against inflation. Yeah, because share prices, if they perform well, they usually outpace inflation, and especially over the longer term horizon, where a lot of data does show that investing in stocks, the right stocks, obviously, and holding it with sufficient length in participation in the market, you do better than inflation, obviously. Okay, participate in the future growth of the company, as I mentioned. But one thing to bear in mind is that shares, as a stockholder, you rank behind creditors, right? So you are almost, well, I would say you're the last person after all the other claims on the company's assets takes place, right? From taxmen to employees to creditors, secured creditors, unsecured creditors, you're also behind them. So in a way, you participate in the growth of the company, but you know that you rank behind creditors. So there's a risk return trade-off there. Okay. Another very common asset class are bonds or fixed income instruments. Sometimes it's called fixed income. These are debt instruments, IOUs, issued by businesses. Typically, it pays a coupon. I say typically because sometimes there are zero coupon bonds as well, but typically it pays a coupon. In other words, like an interest. Okay. Yearly, quarterly, semi-annually, depending on the structure, right? Now, bonds are, you are lending money, so you actually rank above shares. So in terms of the risk return, just now I said shareholders, you rank behind creditors. So if you're a bondholder, you rank above shareholders, right? So sometimes it's used as a tool to hedge or to diversify one's investment portfolio so that you're not overly weighted onto equity risks, but also have a bit of balance. Bonds are, I mean, if they're wholesale bonds, they are chunky. You know, each subscription can be $200,000-$250,000. So sometimes it's not so easy, readily accessible to the mass market. So in Singapore, we have some some retail bonds which are issued in smaller denominations. But a lot of us also sometimes buy bonds through funds, right? Bond funds, unit trust. So you are actually buying into a bond-like investment that pays regular coupons, but because you are buying as a collective scheme. Okay. Others, I think they listed here. Others could be really hybrid of shares and bonds. It could be convertibles, right? A bond that can be convertible into shares, or you can have more derivative-linked products. We talked about other instruments as well, like insurance-linked policies that has bonds or equity as their underlying portfolio. Another class of investment, another asset class are collective investment schemes, right? Collective investment scheme, as the term implies, is a collection of investors who pool their funds together collectively. Typically, unit trust is one of them, right? You invest into a fund, and the unit trust is professionally managed. Okay, this is a very tailored collective scheme. Usually, the unit trust has a particular theme, a particular industry focus, or a particular it could be commodity based as well. So there's a theme behind it, right? It provides diversification to some extent, because if you don't want to put all your eggs in one basket, unit trust does give you a chance to diversify. Exchange traded fund is another collective scheme, a little bit like unit trust, but the difference is that it is listed exchange, that means listed on a stock exchange, and it is usually passively. There's no active management, so they usually link to an index, and there's no active management by the fund managers to juggle the basket. Okay. REITs are very popular collective investment schemes. Real estate investment trusts. Many Singaporeans also have a penchant for real estate, so this is quite easy for them to understand. So instead of buying a single property, you buy into a REIT that invests in multiple properties. Okay, again, it can be different theme, different industry, and the unique feature, of course, it provides also a regular cash yield from the underlying properties. Premiums. Investment linked policies are, well, the collective investment scheme part is because every insurance you buy, the insurance premium that you buy, a portion of it goes to buying a unit trust. So you are also buying indirectly into, could be a bond fund, could be an equity fund, or a hybrid. Okay. Right. How to get started in Singapore? These are the steps. There are a couple of ways. If you want to be a little bit of a hands-on investor, it's good for you to have your own CDP account, so that this is really an account that holds all your listed instruments. So it can be bonds, it can be Singapore government securities, it can be obviously shares as well. Okay. Or once you open a CDP account, if you have your own CDP account, it is yours. It doesn't matter whether you change brokers or not, it's still your CDP account. If you go through, let's say, a bank or a broker's own CDP account, you are tied to that bank and that broker, right? So many of you have also gone to maybe started regular savings plan, RSP, the fourth point below. An RSP with DBS Bank, for example, you don't have to open a CDP account, because DBS will custodize your shares. But that means you are in a way tied to DBS for future investments. Okay. Whereas if you have your own CDP account, you obviously can go to any different bank or any different change brokers if you need to. Open an investment or brokerage account is to enable you to transact. So if you want to transact actively directly in the market, you need to have a brokerage account, and you can transact either online or through the traditional way of calling your broker. Other ways is, like I mentioned, through the bank. That's through the RSP approach, or you can speak to a banker or a licensed financial advisor who can help you to also start your investing journey. Some important considerations before investing, just to highlight a few. These are sort of big picture. You always need to know what your investment objectives are. Any pool of funds that you invest, you need to know what your goals for that fund, what is the objective, right? Do you want to seek growth? You want to seek passive income? You want to preserve your money so that it's not at risk, but you want a little bit of growth? Where are you in terms of the risk-return paradigm? So your risk tolerance, obviously, the risk tolerance is a function of your circumstances and your commitments. Investment horizon. Investing is not a short-term 6-month or week-to-week thing, right? I like to draw a slight distinction, a very important distinction between investing and trading, right? While trading is some form of investing, but trading, the pattern, the behavioral part, is a very short-term practice, right? Whereas if you are investing, and when we talk about investing, really we're talking about a longer term horizon, right? You may need to invest 3, 5, sometimes even 7 years, depending on the asset class and the underlying entity that you're investing in, right? Investment strategies, understand a little bit about this. Very typically, we'll talk about diversification. be careful not to put all your eggs into one basket. Understand you need to diversify in between asset class. I mentioned just now, right? Bonds can be used a little bit of to counterbalance, or REITs can be used as a counterbalance to holding too much equity. Understand types of financial products. So there are many types. So it's good to you have to understand how they work, at least the ones that are attractive to you. So you need to understand the underlying. How do these financial products generate returns? What are the risks behind those returns? And last but not least, consider the cost, right? Because no point making 5% if your fees and costs and your commission and all that stuff takes away 3% or 4%, and then you're left with 1%, and you ask yourself, why am I doing this, right? So always consider transaction costs to get your net returns, and then review your investments from time to time, because terms changes, markets changes, cost change. So you need to know, always keep a good track of your report card. Okay. All right. We should be able to go to our questions now. We'd like to go to our questions. So to do that, you could scan the QR code, input your questions into Slido. We have some questions already that we receive, but we'll take fresh questions. So I will pause here for you to do your QR code and input your questions while we wait for the questions to come up. Okay. Okay. So for those of you who are new to the investment journey, ask your questions. Ask. Don't be afraid. Ask. Don't be shy. Ask any questions. Even if it's deemed to be basic, this it's always good to get these clear before you move to the next level, right? Okay, we are getting some questions. Okay. Once again, if you have any questions, please scan this QR code and input your question. Okay. First question that's coming up. Okay, I see this very small window. I heard many people say investing is like gambling. Okay, what is the difference between savings, investing, and speculating? Right. Very good question. This is very common. I'm sure anecdotally you hear people say that, be careful of investing, it's like gambling. I draw a very important distinction, right? Firstly, let's understand the distinction between savings, investing, and speculating. Okay, savings, we all but probably know what it is, but let's make it very clear. Savings is where you cannot risk your capital, right? Whatever $1,000 you put in today, you must get $1,000 back at the end of the year, maybe with a bit of interest. But the important thing is that the $1,000 doesn't get eroded, or there's no chance of the $1,000 becoming 1,200. Okay, that is the definition of savings. You cannot risk any capital erosion. Investing is different from savings. Investing is you are prepared, able to take some capital risk, but with the opportunity for getting higher than your $1,000 capital principal, right? So that is and investing, I mentioned to you, depending on your objective, right? Whether you want to get you want your 1,000 to be 1,500 in 1 year, or 2 years, 3 years time, or you're happy to it to be 1,000 and then but get some coupons along the way. Okay. In speculating is, well, closer to gambling. Speculating is really where you are just purely hoping that your prices will change. Somebody else will actually buy at a higher price, based on sentiment, based on demand and supply, based on a lot of market psychology, right? Speculating can make you a lot of money, but you can also lose a lot of money, right? So speculating is much closer to, in a way, gambling. Okay, so investing, it is not like gambling if you understand the difference between savings, investing, and speculating. Okay, so if you speculate, you are closer to gambling, but you're investing. Firstly, you are, if you do your homework, you are is based on well researched and data driven analysis and understanding of the underlying asset class that you're investing, then you are controlling the odds, right? If you walk into a casino and gamble, I can guarantee you, you have no control of the odds. You have no control of the blackjack table or the jackpot. So that is gambling. Okay, whereas investing, you have some ability to understand the odds and to manage the risk. Okay, manage how much you want to put in at what time and how long to stay for your investment. Okay, so there's a difference between savings, investing, and speculating. So that's the first question, right? The second question is about dollar cost averaging. Okay, does it work? So first, let's understand what DCA or dollar cost averaging is about. Some of you may have heard of it. It is basically in a way of, when you invest in installments, okay, to put it very simply, right? Some fund managers or some financial advisors uh, uh, recommend that. In fact, if you have an RSP, a regular savings plan, where every month, $150, $200 is debited from your account, and you would select a particular product to invest in, you are in a way practicing dollar cost averaging, because you are buying at installments. It has certain advantage in the sense that you don't have to worry about prices going up and down, right? You are buying generally at an average. You will be better than the average price for that duration. Let's say 1 month, if you had done dollar cost averaging for that month, right? Does it work? Is $1 million question. When you may say, does it work? When you say does it work, are you trying to say that it will always make you? It's always a sure bet that you will do better? Nothing in life is sure bet, especially with investing, right? It does help you to smooth out your cost, and it does help you to alleviate having to time the market, which is very risky. Okay, but of course, you want to make money in any investment. It's not just, you don't just rely on a strategy like DCA. You also have to account for many other things, right? What is the market environment? What are market outlook? Okay, the risk factors that are behind your investing as well. The next question. Temasek recently issued a retail bond, Astrea. Yeah, Astrea 6, I think, is the latest, right? Astrea is is not, when you say Temasek recently issued, okay, it is really wrong, because Temasek didn't issue. It is a special purpose company, which is a subsidiary of Temasek, so it's not Temasek, right? And the bonds are retail, so they are smaller in denomination. So a lot of people in the public were interested. I think it was pretty well oversubscribed. So it's already in your 6th iteration. There were many different tranches earlier. To address the question, since it's Temasek, should it be a good investment? Again, I mentioned to you, Temasek is not the issuer. So Temasek also did not guarantee this bond. So that from an investment perspective, there is no direct Temasek risk recourse. You're not getting any risk protection from Temasek. The only comfort you have is the name that is 100% a subsidiary of Temasek. Understand what the bond is investing. The bond is people lending money to Astrea SPV to invest in some a different asset class. In this case of Astrea, is investing in private equity funds, right? Understand what private equity funds are and what these funds in turn use the money for. That is how you do your homework, to understand whether the investment is good or not good, meets your appetite, or meets your risk appetite or not, right? But it is definitely not, not guaranteed by Temasek, or you don't have no risk recourse to Temasek. Okay. Many have commented that markets are at all-time high. Is there still value in the markets to invest now? If not now, then when? Well, when you say markets are all-time high, you're talking about prices, right? Prices are all-time high. I mean, prices go up and down in the stock market. Warren Buffett famously said that investing is not about price, right? He doesn't care about price. He looks for value, right? So it doesn't matter if you invest in something which doesn't just because a stock is $1,000 is more expensive than a stock that is $1. The $1 stock could have more value because it's a lot more fundamentals um, going for it, right? So if prices are high, generally it speaks that a lot of investors are prepared to pay multiples on various stocks as a whole. Then yes, there is a danger that it is too expensive, right? You have to look at what's part of the market that you're interested in, right? When you say value in the market, well, there could be certain value in the market, like the theme now that's going around or has been going around for maybe about 2 weeks ago, a week ago, was that because a lot of economies are opening up, especially the western part of economies. So there was a positivity on the traditional stocks, the cyclical stocks, as it were. And so the money's moved up from tech stocks to these cyclical stocks, and people felt that there were value in these cyclical stocks, so there was a lot of money being pumped in, right? But then again, after a while, the mood changed when prices are chased up. So when you want to invest, it's not a question of timing. So it's not a question of if not now, then when. Look at the fundamentals of what you're investing, the class that the industry that you like to take a look at, the selected securities within those industry, follow it for a while and try to find whether there's value in it, right? It's not about price being high or low, but the question is, what is the value now, and going forward, what do you think, based on the stuff that you read, based on the research that you can make, whether you see that the outlook for this particular investment is positive or not. If it's positive, then there's always value, right? No matter the price. Okay. So I hope that addresses question. Next question. What is your take on this stash away, etc.? Okay, I think we had this question previously on digital tools, but Robo Advisors, well, they are AI-driven financial advisors, which give you, help you to understand how to start your investment journey, how to profile yourself. So the AI is profiling you with a bit of questions back and forth, and after that, they sort of give you a profile of yourself and then recommend. After the Robo Advisors profile you, the next stage is to recommend certain types of asset class or asset basket that fit your profile. Okay, that's the theory behind it. So it is useful, good for people, especially who are, I guess, starting out, who have maybe a little bit unclear where to even or how to profile themselves. They don't have a good sense of their own risk profile, their own investment objective, for example. So this AI tool, Robo tool, is useful. They take into consideration your demographics, your age, your income, your some financial context, and then it helps you to make some sense of what kind of profile you are. So useful if you're starting out. Useful if you have a lot of assets that you actively manage, and sometimes you want to automate certain things. I've heard people saying that as well. But they are not going to be very useful if you have some very unique requirements, or after you have invested for a while, you like to take on a little bit more nuance in terms of your investment strategies, right? You want to assess certain asset class as an example. Okay, so then you need to speak to obviously a qualified financial advisor. Okay, what to invest in if more financial resources are needed in a few months let me try to understand the question. What should I invest in if more financial resources are needed in a few months to a year? I think what this question means is that you cannot put your money too long. Maybe you can only put maybe 6, 7, 8 months or whatever, and then to a year maximum. Well, then your product classes will be a bit narrower, because if the time frame is short, generally the returns, risk reward returns will be less, right? So you may want to look at more short-term papers. You might look at certificate of deposit from some banks. You can look at treasury bills. If you understand the Singapore's government risks, you are happy to take that. You can also buy T-bills, right? Buying stocks and shares, if your timing is too short, you will unlikely generate the kind of returns for as a value investor. You probably hope to make speculative gains, which is a little bit risky, right? So if you're going to invest in something short, and you are starting out, invest in stuff which are more traditional, right? Stick to maybe Singapore savings bonds, for example, which gives you the liquidity, and you can cash out anytime, so your yield is short and it's pretty safe, right? And stick to stuff which perhaps under a year insurance companies do sell you, for example, single premium policies which are short, under a year or a year. It gives you certain guaranteed returns, right, at the end of the year. Don't expect the yields to be high, obviously. I just started my first job out of school. Should I start investing now? How much should I invest? Okay, this is a very good question for someone who's starting out. Okay, first job out of school. I presume you are single still, so you probably still not carrying a lot of commitments. My advice is to make sure you build up your savings first, right? You can start investing. You can start your investing journey already. Start small. One very common example way is to use an RSP, or like I mentioned just now, somebody asked about Robo Advisors. You could also use a Robo Advisor to profile you, and then start putting money in a small but regular way. Okay, take advantage of that regularity, and then take advantage of the fact that you are starting early. You have the benefit of a lot of compounding, right? But do not do not go into stuff which you don't understand. So get your profile clear. Okay, understand yourself. What are your investment objectives, right? What kind of risk appetite do you have? And then look at the various types of products in the market. Okay, how much to invest nowadays? RSP starts as low as $100, 150 per month, right? Understand the transaction cost so that it doesn't eat up too much of your investment amount, and then you can look at all these things. Okay, so you can go to the local banks, any of the local banks, any of the local brokerages here. Also have regular savings plan. Understand where they are putting their money, what kind of asset class, whether that fits your risk profile and fits your objective, right? Fits your outlook for the industry. Okay, so definitely should start. I mean, I would always recommend starting early, because you have time on your side, and investing is all about leaving your money in the market to generate returns. Don't be caught up with too much of the hype, especially if you are you're out of school, and you're probably hearing a lot of hype from people about a lot of fads about investing into some of these very more speculative stuff. So just be very careful, right? Next question. What are the indicators to look out for to judge if a stock is worth investing in? Okay. This is where value comes in, right? I'm a value investor, so I'm a bit biased on that. Typically, you look at the fundamentals of a company, right? You look at how the company is managed. Obviously, you have the usual financial data, which is only one way of looking at a company. It's a bit historical, but it gives you a report card, right? But you also look at the other soft factors. You look at the industry that the company is in. What is the outlook for the industry, right? What are some of the risks, what they always call headwinds, that could be affecting the company in the near and medium term, right? Of course, we don't know everything. No one knows everything. So therefore, you need to be able to make some calculated risk. You know that even if the company, let's say, is under some stress, if the sales should drop, how how um, how much of a stress can the balance sheet of the company take? So do a bit of homework, right? You need a bit of financial homework to be there, to do a bit of an analysis, and you find that the company can take a 20% fall in its business. It will still be pretty solid from a book value, from a tangible basis. Then there is value there, and if you have faith in the industry, you think that the macro factors for the industry is good, then these are all these are all positive things that you can check off, right? And once you reach enough comfort level, you it's a rational decision to make that kind of investment. Okay. So indicators, from financial indicators to macro indicators, right? You have so many of them. Okay, that is in the course itself. Okay, please share your investing journey from beginning till now. Wow. Briefly, okay, in my investment journey, like I said, was started as a passive investor. Okay, investing in funds purely because of restrictions. Didn't like the performance of funds. So some funds good, some funds average, but I would say majority was very mediocre. So the moment I had the opportunity to become an active investor, I took the opportunity to do so. So actively about 10 years ago, I started with industries which I knew, which I was comfortable with, and which really, in a way, Singapore centric. So always start with something you are comfortable with. You feel you have enough exposure. You may not know everything, but you have better feel, because maybe you worked in the industry or you've been following the industry for a while. So I started with financials. I started with real estate in Singapore. So that was the safe location. Data was here. You don't face regulatory risk. You don't face too much of cross-border risk or FX risk, in fact. So you control some of these risk dynamics, and then you move on from there. Then from there, you start investing, you start understanding, okay, even though you invest in a Singapore company, the company also has overseas investment. So you start looking at the overseas dimension. How do these factors come into play, right? And then, of course, no active investor, I think, can avoid the major market. So eventually for myself, it brings me overseas to look at, to invest directly into, or to invest into the US market. Most obviously first, I also invested in the Australian market because of some factors that I am comfortable with. And about 2 years ago, I started looking quite actively into the Chinese market. And still remain exposed there. I don't have a lot of investment in the Indian market. I don't have a lot of investment in Japanese or Korean market. I have some investment in the Taiwan market, but that's purely to give me some anchor into the more dynamic economies in the region. All right. Yeah, so that's sort of a nutshell. But so all in all, and when you invest, one thing is to always know where your goals are. Be very clear, because you always need to be able to take stock and take your returns as it comes. Are Singapore savings bonds a good investment given a low interest rate now? Well, good in a sense that is risk free. So if you are very risk averse, it is good. Yes, low interest, so the interest is not as appealing, and currently it is probably on par, not as great as a fixed deposit. A couple of years ago, it was better than fixed deposit. It was a no-brainer. It was much better to put in SSB. But it is it's a good way to it's one of the it's a good product compared to fixed deposit, because it is liquid. You can get your money back at any time without any penalties, unlike a fixed deposit, which you may be penalized if you premature the deposit, right? So you get good interest, comparable, right? You get better risk, and you get the liquidity. So if those are your drivers, you need some liquidity at a short notice. It is better than putting your money in a fixed deposit, and it is also better than your savings account. So good from that perspective. But if your definition of good is to make 4-5% return or 6-7% return, then obviously it is not good. So if you aspire for those kind of returns, then you need to look at higher risk category. You need to look at the equity market, or some fixed income instruments which pays that yield as well, but longer tenor that you have to put your money, right? So that is the definition of good. So that's depends on where you stand in that definition. The next question: what is value investing? How is it different from growth investing or contrarian? Well, value investing, I really alluded a little bit just now. I said I'm generally a value investor, so I look for the fundamentals of the company. I look for the fundamentals of the growth of the company, right? What are the company's plans in terms of their growth projections, and how do these plans translate in terms of the value of the stock, right? If they translate very decent in terms of the value, that means their future plans, right? And you look at the value of the stock today, and if those plans pan out, the price would be going from here to there. So that is the value that you will identify. Okay, so that's what value investing is. Growth investing doesn't look so much at it looks at where the company can grow in terms of especially top line or the growth in the industry, right? So the company may not be making money, for example, right? Many of the tech names, the FANG names that we hear today, a couple of years back or more than a couple of, they were not making money, but people were still investing because they were looking at the growth momentum that people anticipate for these companies, right? So you really ignore the value of the fundamentals of the company. You're looking at more the growth of the industry in which this company is going. Usually, it is very dynamic, fast-growing industry, new technology, new innovation, the kind of sectors. Okay, so if you're investing in that, you really have to you're putting your bet on the growth of the company. You are ignoring the fact that the company is losing money, for example. Okay, contrarian is really to ride the cycles, is to be contrary to in other words, when people are selling, people are dumping the industry, you're buying it, right? Most recently, of course, we talk about the pandemic affecting the aviation industry, right? So if you have strong belief that you will, the aviation industry will recover despite all the challenges, then you may be prepared to buy. You are in a way behaving contrarian to some of the current outlook. Okay, so there's some people who do that because they believe that they are going to be well rewarded when the market comes around. Why are markets so bullish when the fundamental is not really sound? Now, COVID impact. Markets don't markets are priced with a eye that looks forward, right? Some people have, all these analysts say that at least a 6 months outlook, but as we know, especially if you invest in growth stocks, you are looking actually not at today's scenario. You are anticipating what is going to happen in a year, 12 months, 18 months, even 24 months down the road, right? So why are markets so bullish? The COVID impact has sharpened a lot of, in the early days, sharpened a lot of people's attention on the value of technology companies and technology. We are using technology now on this platform and Zoom and all the stuff of the world. Plus the fact that people are stuck at home more often. So guess what? They're going to start playing more games, I guess, or watching streaming. So the market suddenly got acutely aware of how valuable this company is. So clearly, due to COVID, so they priced it. They priced it a lot much higher, a lot more in terms of the expected profitability of these companies. So they're looking forward at least 6 months. And now with like I mentioned to you, some positivity on reopening of many economies, getting to the new normal of living with COVID, for example, and therefore, those stocks that have been hammered very badly, aviation, cruise line, some of the even the energy industries, right, or the infrastructure companies, they believe that things will come back up. So because it was hammered so badly, there could be value there, and therefore markets are actively, aggressively investing into this. So therefore you see the bullishness there, right? We have to be careful when the market is driven on such sentiments, because as we all know, some of us who have invested in long enough will know sentiments change very quickly. The views change very quickly. So you have to always be a bit more careful when you are looking at this. Don't put too much of sort on some of these things, right? Always, to me, again, as a value investor, do your homework. Make sure that there is still some meat or something tangible that you're investing in, and not so much just on expectations and bullishness. Okay, market exuberance is a very dangerous thing. Next question. I like the idea of combining protection with investment. Best of both worlds are ILPs good products. So ILPs, for those who, is investment linked products, right? Insurance usually comes to insurance and is linked to an investment. So that's why they talk about combining. So you're getting 2 for 1, or two in one coffee, for example. It is good if you are already well protected. Okay, because in my view is that when we buy insurance, our focus should always be on protection, right? Otherwise, why buy insurance? So if you already have your life insurance for your family, for your dependents, generally taken care of, then if you are going to look at additional insurance, or you want to look at ILPs, then you have to balance against the performance of the ILPs. If you're going to buy ILPs with the eye on making it as an investment tool to expect, aggressive growth in the investment part of your ILP, my experience has been is always not so good, because firstly, the product itself is, you're putting a small little portion into unit trust, and this unit trust, apart from the fees that they charge, it tends to be too small to make any impact as an investment return, right? Too small to make any impact. So you may end up after a few years saying, how come my investment in this ILP is, the returns are so paltry, because it is the nature of the way the product is crafted, right? A large part of your premiums goes into your insurance, okay, for insurance purposes. So they are good if you don't have the time to invest, perhaps, and you want to, to have 2 dimensions of your financial requirements taken care at the same time, protection with a little bit of growth. But my experience is that the returns are generally not very good on the ILP side. Okay. If a person earns X amount per month, what portion of X amount should go into savings? How much of X should go into investing? Okay, financial prudence, financial planners, I'm telling you the usual spiel, tells you that you should put aside at least 20%. Okay, some papers put 10%, but really in our context, minimum 20%. If you can, higher will be better. Of your income, take-home income per month should be set aside as for savings, right? Build up the savings buffer. Okay, build up your emergency savings, right? We've always been taught, put up at least 6 months or more of your income into build up an emergency savings account first, equivalent to 6 months of your expenses. Then after that, you can start building different pools of funds to help you in your investment journey, right? Build up pool A, pool B. Each pool you can start investing once you reach a certain critical size, right? What do I mean by critical size? I would imagine if you're not doing an RSP, maybe you want to build up maybe about a few $1,000, $5,000 to $10,000. Then you start looking at investing where then the cost economics makes sense, right? How much of X should go into investing? Okay, don't forget, after putting aside, let's say you put aside 20% of your income as savings, for savings, you're left with 80%, right? You still have your expenses, you have your living expenses to meet and all that stuff, right? Make sure that you take care of insurance as well, apart from your necessities, right? Do not invest more. Rule of thumb, do not invest more. I would say do not invest more than 20-25%. Okay, try to keep it around that level. Don't go overboard. In life, never go everything overboard. Okay, so depending on how much you manage your expenses, whether you still have that 20-25% left to go into investing. If you do, that it will be a good amount to work at, right? Of course, depending, I don't know this question, depending on your stage, your life stage. If you are single, it's quite different from someone who is starting a family. Your commitments are different, so you may not even have that buffer of 20 to 25% cushion to invest. So different life stage, at a certain life stage, that amount may be smaller. Then as your life stage changes, the amount could come up again, right? Should I buy gold for my portfolio? Well, should you buy depends on why you are buying gold, right? Why do you want to buy gold? What is your purpose behind? Do you understand gold or gold? No, gold can be different types. It can be physical gold, could be derivative gold where you don't really buy a gold, but you buy an option to own gold, or you can buy into exchange traded funds, right? That has underlying gold indices that they track. So you depend on the purpose why you are buying gold. Okay, but it is the prices have gone up very strongly in light of the current economic plus interest rate environment. So it has its fans, it has its benefits. I, for one, don't see the need to buy physical gold. I do have exposures to gold-related derivative products, but not physical gold. The reason for it is purely because for me, it's purely just to diversify, just to use it as a hedge at a particular time, right? So you need to know why you're buying it and what kind of gold products you have to buy. You are buying. Why does it make sense for your portfolio? Okay. Is dividend investing a good approach? It is a useful approach. It is a useful approach if you are seeking, obviously, the income stream. You are very much a longish term investor. You also believe that this company has the ability to sustain the kind of dividends, right? Whatever industry is, maybe it's a very there's a lot of it's a fairly defensive industry, a utility and very defensive industry. Then it's a good investing approach if that is the industry that you favor, or one of your favored industry, right? So it is a useful approach. Should it be the only approach? No. So that's my take. Next question. S-REITs are said to be okay. Address the same question, please. Say something like that. Yep. Okay, there are quite a bit of questions coming out, so I will just pick up a few more because in interest of time, right? S-REITs are said to be good income generating investments. How secure is the income? What are the risks? Okay, REITs useful and is a good asset class, especially if you pick obviously the right sector of REITs, and you've done your homework in terms of the REIT managers, and understanding their track record and all that kind of stuff, right? So it is a good investment. It is also fairly I would say secure. It's not guaranteed, but they are incentivized, especially in Singapore. A lot of the REITs are incentivized tax-wise to distribute up to 90% of their income. So you do get a strong incentive to give you regular income. Okay, what are the risks? Just like in all investment, you have the market risk of the industry that the REITs are in. You have also other risks in terms of the management of the REITs, and whether management comes up to scratch, and whether there could be any specific issues that affect the underlying assets themselves, right? So these are market risks you have to take, risk of that sector as well. Okay, but it is definitely a very useful asset class. I still do use them as part of fixed income kind of element in the portfolio. Okay, we are almost out of time. So I will take this question, which seems to be in the headlines recently, about scams, right? It seems there is an increase in financial scams. How can we better protect ourselves, especially those investment scams which look quite legit? Okay, I think we're focusing on investment scams rather than financial scams. Yes, the trade-off is that Singapore aspires to be a major financial center, and because you're a major financial center, you open yourself to a lot. You have to allow innovation and some level of creativity, and therefore a lot of companies are able, or entities are able, to offer different investment solutions. Clearly, some of them, turn out to be a bit more flimsy, and once things get flimsy, there's a risk that they may turn out badly, right? So how can we better protect ourselves? The bottom line is what we always tell our participants is to do your homework. Okay, ask, check, and confirm is always a famous 3 words. But where to ask, how to ask, where to check for, use resources which are readily available to us, right? The MAS has a fantastic resource on his website, right, which allow you to check on the bona fides of a financial entity. Okay, so there's a financial institution directory that can allow you to check firstly who this company are they regulated by the MAS or not. If it's on a MAS alert list, you should be a bit more careful, because there could be a misunderstanding in terms of their regulatory status, right? And also check on the representatives that come to market, or you may happen to meet with someone. There is a register or representatives function that you can literally ensure that these people are registered sales financial advisors, right? To better protect, always stick with regulated investment products. Okay, better still, if it's exchange listed, you have a lot more protection in terms of the settlement, right? Deal with parties which you always know they are well regulated, right? I don't have to tell you, you can deal with banks and all that stuff. Okay, so stick to those things which are visible, transparent, and well regulated. Then you should be in a good position. Okay, all right. We have about 5 minutes or so. We will wrap up, and I will go back to the slides. Okay. Okay. So we're back to you should be seeing my slides now, hopefully. Okay. So if we didn't manage, or if I didn't manage to answer all your questions, have no worries. What you can do is continue to engage with us. You can still post your questions at our newly launched FinLearn portal, finlearn.sg, or you can email to IFL at the link as well. The unique thing about this FinLearn portal is it enables all of us to continue with our financial inquiries and education. You can join chat topical groups, topic of interest, where you can get yourself into discussion groups and post your questions, and the trainers at IFL will pick up those questions and send and reply, right? So you can keep on developing and developing your understanding and your knowledge in areas that interest you from a financial journey, financial literacy perspective. Okay, so with that, we come to almost the end. Leave you with some useful links that you should just be aware of. Obviously, you can go to MoneySense, our sponsors, which their homepage, you get a lot of useful information. Even recently, with the launch of My MoneySense to help you in your financial planning. IFL's homepage, FinLearn portal, as I mentioned, and the rest are the market access pages that you see, Stock Exchange and SIAS. All right. Okay, more links or channels to keep in touch with the IFL. And before we go, we like to advertise the next session under our Facebook Live, which will be on the 25th of August. This one will be focusing on MoneySense for your child. Okay, very useful for young parents or parents to be, or even parents of teens who wish to get some tips and ideas on how to impart strong sense of money for your child. I find it very useful. I've gone through that journey myself as well. So do join us on the 25th of August. All right. Okay, so without much further ado, I think we will close. So thank you for joining us today and have a good evening. Okay, just